Now over to Google, and Harold would love for you to walk us through a potential option trade here as we see the stock hold in a sideways range that also coincides with a buy zone.
All right, so that's exactly what attracted me to Google was its relative strength relative to the overall market. Google is holding up very well. All I'm doing now is I'm waiting for it to get up above the 21-day exponential moving average. So, and it's right there. So, so that's my my thesis behind
Thesis.
right
Yeah.
behind Google is it's its relative strength. That's exactly what you want to look for in a market like we're in right now. So, let me get set up here.
And as Harold does, so we're going to be taking a look at a bull put spread in Google.
Okay.
So looking forward to going through all the numbers with you, and you can tell us about what expiration we're going with and the details of the trade. Over to you.
All right. So got my thinkorswim up, and we're going to be looking at Google ticker symbol GOOGL, and I'm going to go out 60 days out. So ideally, I like to go out in between 45 to 60 days, so we're right at the upper end of the time range. So I'm gonna go out to the October 20th expiration, and I'm gonna start out. I'm gonna be selling the 120 put, and then I'm gonna buy the 115 for protection. So I got a credit right now. The credit's at 99 cents, as you can see. I'm gonna raise that because based on my numbers, I have $1.21. So I'm gonna change that so it'll match the numbers, and then I'll make a decision. I might take the trade, I might not. But let's just go through the numbers that we have here. So based on the pre-market, it was at 121. So let's take a look at the numbers here. I'm going to click on confirm and send, and here are the numbers. So first thing I like to look at is my break even. 118.79 is my break even. The stock is trading at around 127. So break even well below the where the stock is trading right now. And then of course we have our max loss and the credit receipt. So now let's take a look at two things. We're going to calculate our probability of success, and then how many contracts are we going to buy. So let me edit that. And then on the left side, I got some notes here. So probability of success. So to calculate that is two steps. First thing we need to do is determine what is our risk in the trade. And we do that by taking the width of the spread, which is $5, the difference between the 120 strike and the 115 strike, a 115 strike. So we take the width of the spread minus the credit received, and that's going to give us our actual risk in the trade, which is $3.79. Since we're talking about options, we multiply that by 100. So $379, that's our actual risk in this trade. Now, step two is determine, okay, what is the probability of success in this trade? To determine that, we take the actual risk, which you know is at 379, divided by the width of the spread, multiplied by 100. So our probability of success is about 75%. So very good probability of success. And then our risk or our return on risk. We know what we're gonna risk, but what kind of return can we expect on this trade? To determine that, we take the credit received, which is $1.21, divided by the actual risk, and that's going to give us 31 point, almost 32% return on risk during this 60-day period there. So no bad return on risk. Now, based on the numbers, how many contracts should we be buying? So to determine that, we take the capital we're going to risk. So based on our portfolio size, our level of risk, etc., we decide, okay, $2,500 is what we're going to risk on this trade. So we take that $2,500, that's our risk capital, divided by the actual risk, and that gives us 6.6 contracts or 6 contracts. Now, what are we going to do with this trade? How are we going to manage it? So first off, our profit target is going to be 50% of the credit received. So in this case, it's going to be 61 cents. So if this trade gets down to 60 or gets up to 61 cents, I'm going to take it, lock in that 50% profit. If it doesn't get there, I'm going to wait till we get to 21 days out, 21 days to expiration. So I'll be keeping an eye on this number. So if we don't get to our close to our profit target, or let's say the trade is working against me, when we get to 21 days to expiration, that's when I'm going to make a decision. Do I want to just close out the trade if I have a profit, or do I want to roll it? Rolling is a way of just buying more time just to see if this trade is going to work out. So based on the numbers I see, okay, I'm gonna send it off. I do have a credit of 121, and as we saw when we first pulled up the trade, it was at 99 cents. But my mindset is, I want to be filled. I don't have to be filled. So I'm going to send this off as we are. Well, first off, I need to change the number of contracts. It's 6 contracts, so let me change that. And firm and send. So again, our break even, and then our max profit, and then the amount of money is going to tie up as far as our buying power, pretty close to that 2,500 there. So I'm going to send this off, and we'll see what happens.
Great. Thank you so much for that, Harold. And I'm going back to MarketSmith, and I have drawn a line roughly at that 118 break even level. So if it goes all the way down there, I mean, that's how much room you have. But if the stock did that, that wouldn't look right. So
Right.
it seems like a pretty logical level to have that break even.
Right. And then just as we normally do, whether you're, if this are a regular stock trade, you have that 50 days. So if it gets down below the 50-day, that's where I might consider saying, okay, you know what? This trade is not working out as expected. I'm just going to close it out. It looks right now we're getting up above that 21-day. So things are looking pretty good on this trade so far. So if you want to do the option, great. Or if you want to buy the shares, you can do the same thing. So either way, this looks like a pretty good trade.
Yeah, we do once again have NVIDIA earnings later this week, which could provide that rocket fuel, or could really weigh on a lot of stocks in the market. So that is something to be aware of for later in the week, that that potential risk there. But there are some key levels to take into account on this chart. And with the option trade, you're defining your risk, right?
Exactly. And so I know exactly what my
That's
risk. So
helpful,
I know my worst case scenario.
right?
That's what I really like about options. I already know what my worst case is, and then I can say, okay, I can deal with that. I'm going to go forward with the trade.